In today's video, we'll break down the value cost averaging strategy, also known as value averaging. You may have heard of the similarly named dollar cost averaging, or DCA strategy, which involves investing a fixed amount of funds at regular intervals. But if you felt like you could squeeze more from the market, such as buying less when prices are high or buying more during dips, then value averaging might be better suited for you. With value cost averaging, or VCA, an investor sets a long-term target for their portfolio, such as a specific growth rate or a portfolio value. From there, they then determine the value path, which sets out the amount of growth that needs to be realized in a particular amount of time to meet the target, such as monthly, quarterly, or annually. If this already sounds confusing, don't worry. We'll give you an example of how this works in a bit. The key takeaway is that value averaging focuses on keeping consistent growth to optimize returns. With value averaging, investors buy more when prices are lower and less when prices are higher. So if their portfolio is up and they're on track with their goal, they can adjust their regular contribution down. If it's doing exceedingly well, they can even sell some of their assets. On the flip side, if the portfolio takes a hit during market downturns, they would then increase their contribution to make up for the gap. For example, let's assume that you're using the value averaging strategy on a portfolio with a starting value of $2,000. You've given yourself the goal of growing your portfolio's value by $2,000 every month. In November, your portfolio went up by $1,400. So to meet your growth target, you invest $600 in the following month. Unfortunately, December saw your portfolio go down by $1,500, which means you then need to contribute $3,500 to make up for the shortfall. Value averaging can be suitable for long-term investors who want a structured, goal-driven investment plan that has a more hands-on element to it. Like any good plan, consistency helps eliminate impulsive decision-making. It has the potential for higher returns because it takes advantage of market variations by investing more during downturns and less during upswings. This can help to reduce volatility in the portfolio, which any crypto investor will likely know all too well. But on the flip side, value averaging also has its downsides. In a prolonged down market, investors could run out of money as their contributions to close the gap get larger. Of course, it also means that if you've picked an asset that's down only, no amount invested will close the gap. The strategy also requires investors to routinely monitor their portfolio's performance, which isn't ideal if you're looking for a more passive approach. As mentioned before, dollar cost averaging is a popular investment strategy often compared to value averaging, as both strategies offer a clear plan that can help lower risks associated with market volatility or emotional decision-making. However, with dollar cost averaging, you invest a fixed amount at regular intervals, regardless of the asset's price or your portfolio value. DCA is great for a more passive approach, while VCA works better for investors willing to be more hands-on. At the end of the day, it comes down to which strategy aligns best with your goals and investment style.